An unfortunate truth is that most traders grossly overestimate their personal risk tolerance. People generally say that if their stock drops 40%, they'll just buy more and hold. But when the Nasdaq drops 6% like it did last week, all of a sudden those same people are panic selling and comparing the US to the fall of the Roman Empire. Everyone has diamond hands until their stocks go red. I promise the Fed raising rates by 0.25% is not going to send the US into a death spiral. We must be greedy when others are fearful. This dip was a good time to buy, and this point demonstrated itself this week. Look at the way the Nasdaq recovered. That is an insane reversal. But if this is you with a 97% loss on calls, or you're getting frustrated because your long-term investment looks like ass after 3 weeks, then here's what I want you to do to start 2022 off on the right foot. To start the new year, open your Roth IRA and make your deposit. We're going to buy long-term investments for tax-free growth. If you don't have an IRA, you can make one on Webull if you really want to, but you're probably better off using your own traditional bank. I use Merrill Edge as my brokerage because Bank of America is affiliated with it, and I get additional cash back on my credit card for using them. You might find the same thing at your bank. For anyone under 50, your IRA contribution limit is $6,000 a year. If you're over 50, you can make an additional $1,000 deposit. If you deadass have no money, refer to my freeloader challenge videos and we'll get you there. You will have $6,000 by December. With the cash in our account, we're going to buy growth funds. You can't touch your IRA without penalties until you're almost 60 and a few other very specific circumstances, so we need to focus on long-term growth. There's no better way to achieve that than with growth ETFs. Here's my Roth IRA right after I made my $6,000 deposit for 2022. Most of it is concentrated in the tech ETFs, so that's QQQ and TQQQ, which is a leveraged ETF. I've also got this relatively large position in Realty Income. The ticker for that is O. This is a dividend stock that pays you monthly. My goal with Realty Income right now is to wheel out of it by getting assigned on these covered calls. So inshallah, the stock will go up another $1.50. I'll get assigned on the calls, and then I can reinvest into the growth ETFs. Some people like to hold dividend stocks in their IRAs for compounding. Of all the things you can do with your money, that is better than most, so it's okay. But dividend stocks and ETFs generally tend to underperform the market. So our plan should be to hold growth equities until we're ready to retire, and then we'll switch to dividend later. This is the maneuver I'm making right now with Realty Income. If it does not get assigned, I'll reinvest the premiums and just try again. My recommendation for your Roth is to buy shares of QQQ or VOO and hold them until you're 60, and then switch to dividend ETFs if you need the income. So that's exactly what I'm going to do here. I'm going to buy shares of QQQ in my Roth. And if I calculate by amount, I can see that a $6,000 deposit right now will get you only 15 shares, which is pretty pathetic. That an entire year's IRA only gets you 15 shares. Luckily, I've got some cash left over from when I sold the TQQQ covered call, and I don't think TQQQ is hitting 170 this week. So let's put that money in here too. I'll get 7,200, and that'll give me 18 shares. All right, I'm going to enter my limit price to the current market price just to make sure nothing gets wonky. And that'll give me my 18 shares, spending pretty much all the money that I have in this account. And that's fine, because this is a long-term investment anyway. All right, we're finally on step 2, and we're going to get our non-retirement accounts in order. So this is your regular TD, Fidelity, Merrill Edge, Robinhood if you're still on it. Here's my Merrill Edge, and we'll talk about this account in a minute. Now, we have to structure our portfolio in a way that actually meets our goals and our risk tolerance. Not what we pretend our risk tolerance is, but what it actually is. On a scale of 1 to 10, most people think that they're here. They're young, they're ambitious, they want the big wins, and they think they're ready to stomach the losses. Most of these people get frustrated and panic sell within days, and I used to be one of them, so I know how this feels. But based on my experience, I think most people are actually here, and this is where I am. I have an average risk tolerance, and the average risk tolerance is pretty low in absolute terms. If I'm going to be doing higher risk trading like vertical spreads or PMCCs or strangles, I need to have a nice solid foundation of low beta, that means not volatile, dividend ETFs and blue chip stocks underneath me. During times like last week when the market was crashing, I was able to stay disciplined because my blue chip stocks were not at risk and my dividend ETFs and stocks paid me out like clockwork, so I was able to focus and not get all crazy. I used to just go for all momentum trades, so that would be calls on AMD, Snapchat, Google, ARK ETFs, just all the high growth names. And when things went south, I lost a lot of money very quickly and I started doing a bunch of stupid things, like freak out and start locking in losses, hold positions open for less than 2 minutes. No one thinks they're going to do that, but everybody does it. And like I said, I was one of them. So here's how I got past this problem. Here's how I think you can get past this problem too. If you're a new investor or you're a serious investor, but you're not very good at it, I want your first move to be to pick a dividend ETF and buy 100 shares of it. If you don't have the money, save up and invest over time until you have 100 shares. I like SPHD a lot. This is the Invesco S&P 500 high dividend, low volatility ETF. It's designed to pay you a dividend every single month and you can hold on to it forever. Some people prefer SCHD. That's a very similar fund from Schwab, but it pays you quarterly instead of monthly. Really similar ETFs, comparing them is like splitting hairs. So pick one, save up until you have 100 shares in your portfolio. And next, I want you to do the same thing with covered call ETFs. That's QYLD, RYLD, or XYLD. Any one of them is fine. I like QYLD the best. I invest a lot into it, and it pays me every single month like clockwork. But don't bother splitting the hairs between the three of them. Just pick the one that you like the best. This is going to be a very small part of your portfolio in the long term. Once you have 100 shares of your dividend ETF and 100 shares of your covered call ETF, you are now virtually guaranteed payouts every single month with no work on your end, and you're a lot less volatile than the market. And yes, that also means that your portfolio isn't going to go up as much as the market when the market is rising. But you know what else underperforms the market? Trading like shit and losing 30% when the market goes down 6%. And this less volatile part of your portfolio will stop you from trading like that. The next part of your foundation is indexed ETFs. This is a balanced growth portion of your portfolio that all but guarantees long-term growth and quarterly dividends. I want you to pick either VOO, that's a low-cost version of the S&P 500 indexed ETFs, Triple Q, that's the NASDAQ, that's generally what I trade with here, although I do have a position in SPY as well using Leaps. Or you can use VT, that's the entire world. If you want consistent growth, betting on a stock or ETF that follows Earth is a good bet. Save up and invest into these until you have about $6,000 invested. If you chose SPHD and QYLD like I did, that'll add up to about $6,500 right now. Pair that with $6,000 of one of these indexed ETFs, and now you've got a balance of growth and dividend, and you cannot lose now. Once you've got that foundation underneath you, do not be tempted to sell these positions, but you're now free to go back and buy your Palantir calls and risk losing money because you have your foundation to fall back on. As you get better at trading and start making more money, reinvest some of your gains back into this foundation. You can't expand your house without making sure the foundation is large enough to support what's on top of it. Maybe choose a dividend stock like Coca-Cola, which is what I did, or choose ETFs that have some more precision to them, like an indexed ETF focusing on a specific sector. Or add to a position in VEU. Now that's what I did as well. I got VEU, which is the Vanguard All World minus the United States, so you get that international exposure. Or go to TQQQ, which is a leveraged version of Triple Q. I traded a little bit more actively, but I also get that additional risk in exchange for that additional return. If you panic sold last week and your portfolio got nuked on short-term calls, please do not blow off this advice. I promise you, you will be a better trader when you know that your portfolio is safe. And if you guys like hearing about my portfolio positions, I give more detail each month on Patreon. You'll get an explanation for this Triple Q straddle that looks like I lost money, but this was actually a strangle that I rolled in on both ends to seize more premium, and I'm actually already up about $600. And every month there's a discussion on this slew of stocks and ETFs that I hold and an explanation as to why I'm holding them and what I expect to do with them. I'd really appreciate the support, and I'll do whatever I can to help my patrons invest. I can't tell you what the market will do, but I can tell you that having a nice foundation underneath you will make a world of difference and make you a better trader. That's all, guys. See you next time.